Hello and welcome to our latest Money Show MoneyMasters Podcast segment. Mike Larson, Editor-in-Chief at Money Show, and today I'm pleased to welcome a pair of brand new guests to the show. We have John Devine, Assistant Managing Editor of Investing at U.S. News & World Report, and Patrick Duffy, Senior Real Estate Economist at U.S. News & World Report as well. Gentlemen, how are you?
Doing well. How are you?
Glad to be here.
Doing great. Since I haven't had the pleasure of having either of you on the podcast before we get into the real estate market conditions and some of the investment implications, why don't you each talk a little bit about your backgrounds and how you got into this, maybe starting with you, John?
Yeah, so I've been I've been covering financial markets since 2012 or so, and mostly have a focus on stocks and the stock market. But recently, just in my personal life, I've gotten more interested in real estate, as well as I just, bought a primary home and have gotten into some commercial stuff. So I understand, on some level and appreciate real estate, and excited to sort of share some thoughts with the crowd in August.
Great. How about you, Patrick?
I have been bopping around the real estate industry for over 25 years now. I've worked for a home builder where I managed a market research department, worked for a couple consulting firms that are still around that do predominantly single family and multifamily, but also some commercial. I actually got into the industry on the commercial side before I went to the housing side. And then a couple of years ago, was recruited by U.S. News to write and contribute as their senior real estate economist. And I also run my own firm, Metro Intelligence Real Estate Advisors, based here in Southern California.
Great. I appreciate that background. And gentlemen, why don't we go ahead and just get into it now? Let's talk big picture. Let's start with real estate conditions on the residential side. Whoever wants to jump in and kind of give us an overview. Where do we stand? What are some of the factors driving the markets here? And maybe how do you see things sorting out as we move into the back half of 2024?
I could start with that. It looks like we're taking a little breather. We're not having the sort of sales activity that we would usually expect this time of year. And I think that's mostly to do with affordability and a lot of people that are stuck in place, and mortgage rates that have come down a little bit, not as much as we need to. That has benefited home builders who are able to buy down the rates more. And that's not to say that existing homeowners can't do that and offer that as sellers. It's just not as typical. I don't know if they're as aware of it. I'm also currently working on a story for U.S. News on climate change and the insurance crisis, something which I also faced recently, where I had to scramble for coverage and looked at all these different companies in the state of California and could only find two that would write me policies. So that's something that's really impacting people looking at homes, because now it's not just the mortgage, it's your variable costs, it's your utilities, it's your insurance, it's your property taxes, which most states don't cap like we do here in California with our Prop 13. And that's making it harder for transactions to occur.
Yeah, there's a lot to unpack there, Patrick. I want to start by talking about the mortgage rate situation. I mean, from what I hear when I talk to other people, you've got people that if they're locked into a 2 3/4, 3%, 3 1/4, whatever mortgage rate, they just really, really don't want to let that go and sell and move. But on the other side of the fence, potential buyers are looking at 7% ish or whatever, and prices that remain stubbornly high, right? I mean, what's your sense of that?
Lack of inventory. It's hard to have what I would call price discovery, which is what actually the price of any product, or certainly a home in this case, would be worth with a normal market with adequate supply and demand meeting. And you're not having that. You're having people scrambling. And so for that reason, we're also not seeing price changes in a lot of areas which have climate hazards yet. We're starting to see a little bit in Florida. I've been reading. But there are other areas, no area in the country is safe from natural disasters. There are certain areas that get more attention. I've been reading about even more strong storms, hail the size of DVD, in terms of just huge in Texas. So it's not just the huge name storms, it's the minor ones. So I think a lot of people, and I talked with a friend last night, people are in like alarm mode all the time lately because of the news. And I don't know to what extent that's preventing it. But I think it's mostly affordability more than anything else that's cramping it down.
John, what would you like to add, particularly on the point that Patrick made about the implications for home builders? Obviously, a lot of publicly traded companies out there in that space.
Yeah, well, there's a huge, inventory sort of gap that needs to be made up, and so that's an opportunity for home builders for sure. But it does kind of come back to this issue of affordability, because you can build all the homes you want, but if people can't afford them, I mean, housing affordability is sort of at its lowest point since basically the 80s, when you had hyperinflation. So it's not a great environment for certainly first time home buyers, although there are some programs for them. But you need to, I mean, there's a lot of golden handcuffs out there, as you mentioned, with people sitting on 2.5% mortgages who really are not incentivized to go and pick up a new 7% mortgage if they move. So, I mean, there's some clever ways to get around it that are a little bit off the beaten path. I mean, there's something called subject to financing, where you can overtake somebody's existing mortgage if you're the purchaser, and you just sort of start paying that note and assume ownership, and get transferred the deed, as I understand it. But it's obviously, that's creative financing, and you have to find a seller who generally has a very large percent, low equity and a big note on the home for it to make sense for both parties.
Got it. Let's switch a little bit here to the commercial side of the ledger. And again, same thing from maybe 30,000 feet up. I mean, where do you see things standing on that side of the fence?
Well, let's look at multifamily. So there's this huge glut in certain markets, and that's slowly being absorbed, and it will be absorbed even faster if people can't find homes to buy. So we're starting to see that. But there's also a lot of issues with rent being unaffordable. You have an enormous portion of people in this country that are spending 30% or more of their income on rent, and a huge chunk of them are spending half or more. And so you're starting to see a lot of places try to bring back here in California some rent control. And the problem with that is that doesn't help new supply. So in the long run, it's not terribly good. It's like a Band-Aid for a larger problem, which is that we need more supply. And so the apartment in certain markets, you're seeing people give away a year, if they want like a year lease, a month of free rent. So we're seeing some of that, but that's mostly in the South. We're seeing a lot of that excess supply. So I'm not too worried about the apartment market in the long run. I think it has pretty good fundamentals. And again, this affordability on the home selling side helps it. In terms of the commercial side, I've been reading that retail is actually bouncing back pretty quickly. Even though we have more retail per square foot than any other country in the world, pretty much, people out of the pandemic prove that, not all of the shopping needs to be done online. Our share of shopping online is a fraction of what it is in like China, where it's like 50%. Ours is still in, I think, just under 20%, and it may go up to 25% in the next few years. So that really helps the retail. So that's starting to bounce back. Office, it really depends on the market. I've been reading about fire sales. The extended pretend for office properties kind of coming to an end. We're seeing some sales because the return to office isn't settled yet. It's sort of settling in around 1 or 2 days at home for remote workers. And employers want 4 in the office, 1 at home, and then employees want an extra day. And so that really depends on the market too. There's a company that tracks Castle Systems. They track people that check into offices, and Houston's consistently had one of the highest rates of return to office, but it's a lot lower in Washington, D.C. And now people are complaining that federal offices, employees need to come back to the office, partly because they don't like them working remotely, and partly because it's led to vacancies in Washington, D.C. So that one's kind of market specific, but I think we're going to see some of that continuing in office. People do talk about converting to offices, converting from offices to homes, but that's tougher than it seems. That's maybe 25-30% that are appropriate for that. So I have said something about converting to retail, like multi-floor retail. So that, which they do more predominantly in Asia, so that could be a use for offices. And I'd say industrial, that's still kind of a really strong market. That's seeing some weaknesses. I know Amazon was giving some leases in the past. but now they're on a tear again, taking more space again. So that has traditionally been one of the stronger markets. And I think even lodging's coming back. Like people want to get out there and rates are up. And so it's very, still as everything else, very sector and geography specific.
Got it. Absolutely. I'm going to shift to the publicly traded REITs and some of the performance stats there in a minute, but I just wanted to throw this out there for either of you want to take it. I mean, when it comes to things like commercial real estate financing, loan losses, CMBS losses, banks that are holding commercial mortgages, things like that, I've heard some people that say it's going to be Armageddon. I've heard some people that say it's much ado about nothing. Any insights you'd offer on that and maybe what the implications are for markets or banks and so on?
Yeah, I can take a stab at this. So, I mean, last year in 2023, you had the regional banking crisis in March, and the federal government, stepped in a big way and sort of guaranteed a lot of those liabilities and really backstopped some of the concerns. I mean, obviously, you had Silicon Valley Bank and Signature Bank and some failures there. But in order to stop sort of a deluge of failures, I think the government really showed its willingness to pull out all the stops. And so I am a little skeptical that there could be utter and total chaos due to some of these liabilities just because of that, sort of telegraphed willingness by the government to step in. And whether that's healthy for the markets or not is another question. But I think realistically, the Fed is going to have that, or the federal government is at least going to have that backstop.
John, let me stay with you because you brought the Fed up and the government and so on. I mean, when we look at the public markets, the REIT space has continued to kind of languish / underperform. You've got the XLRE, the main ETF for REITs, is down about 6% year to date. But if you take that time frame out to the last 2 years, you're down about 9%. I mean, what's it going to take to get this sector out of the doghouse overall?
Well, it's very deterministic. It's basically about rates. I mean, the last 2 years, if you think about it just more broadly, has been a narrative of it's all about the Fed, sort of in a way that a lot of young investors haven't seen before. Certainly, basically since the great financial crisis, rates have been at zero. It was a zero interest rate environment. And so to ramp up to a more historically normal range is one thing. To do so in a span of 18 months or so is totally pretty much unprecedented. And so there was a lot of, shakeout from that, understandably. And again, if you look before sort of the last few years at REITs, during that zero interest rate period, they were doing great. And as you might expect them to, so because they're so reliant on leverage and borrowing costs and sort of using that delta to earn return. So I think the REITs that have been more conservative and are responsibly managing their risk with regard to rates will be well suited, if and when the Fed decides to start, taking rates down. I don't think it'll be as quick down as on the way as it was on the way up. At least we should hope not, because if it is, then there's a huge crisis that we're dealing with.
Yeah, be careful what you wish for. I know what you're saying. Patrick, let me ask or just go over some numbers with you. When I looked at the NAREIT data through April month or year to date through April, it looked like healthcare, apartment, and single family home subsector REITs were performing the best year to date. And you had industrial, telecommunications, and manufactured home REITs among the worst. Now, I know some of these subgroups only have a couple of names in them. I'm wondering if that surprised you. What, based on the fundamentals you're looking at, which kind of subsectors do you think may have a promising 2024 and which might still be sectors people might want to avoid just given the fundamentals?
I would say data centers, that are a big thing. That's becoming a big issue that's another climate change related thing because electricity and water. So maybe they can't scale up as much as they want. But for now, I think the demand there is definitely exceeding the supply. Maybe some other things they overbuilt. It's like everyone's rushing into medical office for a while and depending, like they did in the apartment market, everyone rushes into it. to provide the demand, and maybe they all think they're going to grab a lion's share of supply, and they don't. So it takes a while for that to shake out. I would say depending on the telecommunications, probably overbuilt, and some of these industries are really changing as well in terms of the demand for space. And I looked at the inflation today; it's still flat. It's in terms of the Fed's preferred PCE price index. So to John's point, it's probably going to be a long road. And again, maybe they're looking into the future. I've been talking to developers where projects just don't pencil even for affordable housing now because of a combination of things, including interest rates and also the insurance crisis. They just can't find it. So I think a lot of those things are coming into play. It'd be interesting to delve more into that in terms of these commercial projects, how much this insurance crisis that we keep hearing about on the housing side is starting to impact the fundamentals of that. And then also, as an aside, rising utilities and also taxes, but certainly those variable costs, I think, are rising more than they have in the past. And it's certainly making things less attractive for now.
Got it. Well, I know you're both going to be joining us for the Money Show Masters Symposium in Las Vegas. That's one of the reasons we're having this conversation. Can't wait to see you both there in Vegas to give sort of an in-person take on what's going on at that point. I know we're still a couple of months out, but maybe any kind of sneak peek at some takeaways or things that you think you're going to be talking about there. And I guess I'd start with you, John, and then move to you, Patrick.
Yeah, so I hope to look at, sort of the macro situation where we are later in the summer with the Fed and what it's telegraphed. Obviously, a few more inflation readings we'll have by then, and I think a better sense of how much rates are going to come down by the end of the year, and probably some dot plots on what people are expecting, on what the Fed, governors are expecting next year for rates as well. And I think that'll have clearly some impact on the markets, on the real estate sector. And then I sort of, so that's the macro view, and then sort of want to look at the bottom up approach to look at some specific REITs, stocks, maybe home builders, or even lenders that are publicly traded, that people that maybe look attractively valued, and that folks might want to consider moving forward.
How about you, Patrick? Anything we haven't already spoken about that you think is important, or that maybe you'll be touching on there?
I think over the next 2 months, we're going to be looking at a few things. One is going to be, where economically, where we're at in terms of inflation, in terms of is the market recovering or not. I think weather will be part of it in terms of solving this insurance crisis this summer. I know it's going to be hot. So that means heat and other drought and things like that. So going to follow that. We also have a big, I don't touch on politics that much, but we do have a really important election coming up in another couple months. We might have more indication of what policy proposals each side has. So that could be interesting to track. And it's probably another look at where the commercial markets are. And between now and then, I'm going to be writing and updating a couple more articles for U.S. News on the hottest housing markets, the least hot, a 1-year outlook, a 5-year outlook. So by then, those will be done by the end of July. So I think when we start talking in early August and we get together, we'll have some new fresh data on what to discuss. So I would say stay tuned.
Great, guys. Well, listen, viewers, if you're watching this and you do want to learn more from John and Patrick, they are going to be joining us for that Money Show Masters Symposium in Las Vegas. It's scheduled for August 1st to 3rd at the Paris Las Vegas Resort. You can find out more details in the link in the video description below. Also, don't forget, if you like this video, subscribe to the Money Show channel. You'll get more updates whenever we drop anything new. John, Patrick, thank you so much for your time. I can't wait to see you guys in Vegas in August.
Thank you, Mike.
Thanks, Mike. See you then. And you too, John.